Hey everyone, so the age-old question of investing in real estate or investing in stock market still has people arguing all over the internet. On one side of the fence, you have people that swear by the higher average return of the stock market, the liquidity at which you can buy and sell stocks, and the lower entry level, which means you can pretty much invest as soon as you have any money. But on the other side of the fence, the more established investors all swear by the stability of the housing market, the power of leveraging their money, and the ability to be able to write off their expenses for tax purposes. Now, I personally invest in both, so I'm not biased either way. I want both to do equally well. So today, I'm going to run the numbers and give you an answer for which investment is better off in this crazy world that we live in. And trust me, I was absolutely surprised at the results myself. Let's have two people invest $100,000 of their own money. One will invest in the stock market and the other one will use $100,000 as 20% deposit for a unit or apartment that they will later eventually rent out. Now, $100,000 is quite a large amount of money to put into the stock market, whereas it's quite an entry amount into the real estate. So I think it's a fairly good comparison between the two. To make this comparison, I'm going to need 5 variables, which I'm going to try and work out from the internet, and those variables pretty much dictate which one wins or not. And those 5 variables are the average growth rate of shares, the average dividend return of those shares, the real estate growth rate, the real estate rental rate, and the mortgage rate. Now, there's absolutely no way that we can predict the individual growth of one stock, so we're going to have to take an average stock market rate of around 11% or so, which has been the historical average for the last 10 years. Now, to make it more realistic, I'm going to take half of that $100,000, so $50,000, and put it into a dividend stock, while the whole portfolio will increase in value in its capital by an average of, say, let's around 8% or so. That's probably closer to what most people have in their portfolios, which is a mix of non-dividend and dividend-paying stocks anyway. Overall, this still gives us the average of 11% historically, and I think that's going to continue into the future as well. Now, for real estate, the average annual growth for house prices is around 6.9%, and for units is around 5.8%. But with the current economic situation with the low wage growth and the high unemployment, let's be a little bit more conservative than that, and let's say we'll give it a capital rate return for real estate of around 4%. Since we are renting it out, we will receive an average of about 4% for a residential unit. But let's be conservative here as well and just use, say, 3%, just to account for all the tenants that are falling behind in their rent and the landlords reducing their rent to be able to find tenants in the first place. So now for our mortgage rate, we again need to do a quick search of all the investment loans that are available out there, and we try to find the best loan, because why wouldn't you just go for the best loan? Now, in the current mortgage environment, if your loan has a 3 in front of it, then I highly recommend you call your bank now and ask them for a discount, or you're leaving. You can save thousands and thousands of dollars, and on top of that, you can get thousands of dollars from refinancing as a promotion. So looking at these, it looks like 2.5% seems like it's not unreasonable, so let's go with that. Alright, so now let's get started. So now that we have all 5 variables locked in, we can begin our first year. So for our stock investor, buying $100,000 of shares straight up will cost around $120 in brokerage fees, spreading it out across some dividend shares and some growth shares. And that's pretty much it for the expenses side of things. And that's kind of the appeal of buying stocks, is that there's not much to worry about on the accounting side. Let's move on with the income side now. So with half our shares bringing in dividends, we'll expect to receive around $2,500 in dividend income and a $9,000 capital gain in our share portfolio, bringing a total of $111,000 after the first year, which is an excellent result when you compare it to just leaving it in a bank earning next to nothing. Also remember that dividends are taxed the year that you receive them, but capital gains are taxed the year that you sell them. But for simplicity, let's just leave tax out of it for now. For the real estate investor though, buying a $500,000 property with a $100,000 deposit means that you'll end up with a $400,000 mortgage. On top of that, there's the buying expenses of around $27,000 in stamp duty, which can be exempt if you're a first home buyer looking to live in it for the 6 months and then rent it out. But that's a strategy that we'll talk about in another video. We'll also need to pay bank fees for setting up the mortgage and our solicitor or conveyancer around $2,000 just to keep them happy. We'll then have our regular expenses, which are the mortgage interest, the water bills, the strata, the council, the agent commission to manage the property on our behalf, and insurance fees. So I've used figures that I myself pay in my own properties, so it should be fairly realistic. It's a lot of expenses to be in the real estate game, but the rental income does cover most of it. Now, just because it takes time to find a good tenant as well, I'll put in about $2,000 of missed rent during that advertising phase while the property is vacant. Also, remember that the value of the property also rises every year, just like capital gains of the stock market. Now, I won't go into details of the next 9 years. I'll share the Google Sheets and leave a link in the description for you to do that. But essentially, I've copied and pasted all 9 formulas down 9 more times and renamed the years. The end result totally caught me by surprise and made me go back and recheck all my formulas to make sure it was right. And it was. So the result is that in the current economic environment that we've set up in the 5 variables from earlier on, is that the person who invested in property has almost doubled the net worth of the person who invested in the stock market. I think this is a huge surprise to anyone who's investing in the stock market with an 11 to 12% gain, while the person who invested in real estate only gets half of that, but then they gain double of the stock market person. And the reason for that is because we're using the power of leverage to use the bank's money to make ourselves money. But that only works if the mortgage rate is less than the property return rate that we get. So let's say the economy is doing well and the inflation is running rampant and the Reserve Bank decides to ramp up the interest rate, then our mortgage rates will all get pushed up. And let's say if our mortgage rate is pushed up to 6%, then you can see here that now the two returns are pretty much neck and neck. There's nothing in it. But with the global economy as it stands right now, I don't see that happening for a very, very, very long time. And this is how the battle between stocks and real estate will play out. Real estate wins. So were you as surprised as I was? Are you going to change up your investment plans now? Do you even agree with my calculations? The Google Sheets link is in the description below, so click on it and put your own values in to see what you get. Anyway guys, thanks for watching and I'll see you in the next video.